Hi, welcome to our show, folks. Today we got a great show lined up for you. Have you ever wondered how capital gains are taxed? How about 1031 exchanges when you want to defer maybe some of those gains? How about when do I need a will from an estate planning standpoint? Okay. How about why I might wait to take Social Security from a tax standpoint? Several factors that go into that, but what about from a tax standpoint? And then call options. All right, have you ever wondered how those work? Well, stay tuned. We're going to talk about all of that today.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
In this segment, I want to talk about capital gains, most particularly how they're taxed. First of all, a short-term gain is one in which that you buy a security and you sell the security within a year. If you do that, it's considered short-term and it's subject to what you call ordinary income tax rates, basically whatever bracket you're in. Okay? Now, if you buy a security and sell it in longer than 1 year, okay, now it's considered a long-term gain, and it gets taxed depending on what your income is. Okay, if you find that gain is entirely in the lower bracket, which would be the 12% bracket, then it gets zero taxed. If it falls outside that bracket, then depending on your income, it can be 15 or 20%. But that's all. That's the maximum they can charge you on those. So great benefit if you can try to realize those gains in a lower bracket. Now, a lot of times at the end of the year, you'll get these statements and it'll show you these unrealized gains on your portfolio statement. Okay? Now, all that is that these are securities that you've purchased, you've held, but they haven't been sold. And understand, you're not going to pay tax on them till you sell them. So tax harvesting can be very valuable where you're going in maybe at the end of the year and you're trying to sell off some of the positions with gains and then maybe offset it with some that have losses. So recognizing where you're at in that in tax planning is going to be beneficial. Now, if you inherit an account that's got a lot of unrealized gains and it's a non-qualified account, which just simply means it's a non-retirement account, you enjoy what's called stepped up basis, meaning you can pass those on to your heirs and they get to step up the basis to the fair market value upon your death. So there's cases where you can have these unrealized gains and no gains are ever going to be paid on. Again, you can offset losses with gains. So if you can look at that and try to tax harvest that at an appropriate rate, going to be highly valuable. Now in IRAs, you don't have to worry about it because there is no capital gains. Basically, every dollar you take out of an IRA is going to be taxed. Now, on rental property, you got to be real careful because all that depreciation you took over the years, that has to be recaptured, and the rate is 25%. Collectibles and coins, 28%. And then folks know this, that there's a limit on on the net losses you can take in a year. For a married couple, that's $3,000, but you can carry them forward indefinitely. For single people, that's $1,500. But what you don't use, you can carry forward indefinitely. So folks, if you're somebody that maybe has some of these kind of positions, you don't really know how to tax harvest them yourself, want to maybe a little bit of tax planning to help you with that, then give us a call. We'd be glad to help you.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
What are these expense ratios you find in mutual funds? Most importantly, how much risk can you take on? I want to talk to you about Social Security, the estate tax exemption, ladybird deeds. What are they? Modified adjusted gross income, tax bracket optimization, the sunken cost trap, 529 plans, the financial cycle, the Federal Reserve, income planning, tax planning, holistic planning, fees, bonds. Can I retire? In this segment, I want to talk about 1031 exchanges. Now folks, 1031, all that's referring to is the IRS tax code number that talks about these. Now, in a 1031 exchange, what you're trying to do is defer the gain on the sale of, let's say, property. Okay, so let's say you bought this property for $100,000 originally. Now you want to sell it for $200,000. Okay, so you have $100,000 that you want to defer. In a like kind exchange, you have to buy, for it to be effective, you have to buy of equal or greater value. So for me to defer that $100,000 gain, what I want to do is buy another property for at least $200,000 or more. Now, by doing so, that $100,000 deferred gain gets transferred over to the new property. So let's just say, for all practical purposes, I exchange it for some property worth $220,000. Now my basis in that new property is $120,000 with a $100,000 gain starting with day one that'll have to be paid down the road when I sell that property. Now, I have to be careful because I can't incur any new debt when I do one of these kind of exchanges. That'll create what's called boot and then can make some of it taxable, so you got to be careful of that. I have to use what's called a qualified intermediary. What the qualified intermediary is going to do is going to hold the proceeds from the first sale, and then they're going to hold them towards the purchase of the next sale, where you can't receive any of the proceeds. Okay, it's going to be very important. And there's actually what they call a qualified intermediary agreement that has to be part of this arrangement as well. So they effectively they hold the proceeds, and then they try to make the sale happen properly according to the rules. Now, the property must be like kind. You know, it has to be, if you're doing real estate, it's going to be real estate you're going for. You have to be able to identify that property that you want to exchange for. You have to identify it within 45 days of the close of the property you just sold. So you sell the property for $200,000. Now you've got 45 days to get out there and try to find what property that you're going to purchase. Now there's different ways you can identify these properties. You can identify 3 and then maybe just close on the 1. There's some other ways you can identify a number more properties, but you have to meet certain rules. Now, all that being said, you identify the property within the 45 days. Now you got to close on that property within 180 days. So folks, this is something that you'd like to maybe look at or do. It can be very valuable, but it comes with some very tight restrictions or rules associated with it that you're going to want to know about. If there's anything like that we can help you with, then give us a call.
Great information there, Larry. Thanks for going through that. And one of the things on the capital gains that I want to point out is this idea of tax loss harvesting, where ultimately as you're looking at your capital gains, whether long-term, short-term, and you're approaching like the end of the year, you want to look at, hey, how much do I have potentially built up in gains, but then potential unrealized losses as well, where you can sell some of those positions to help offset the two. So that's something that I know a lot of people aren't necessarily looking at, but important to do, right?
Yeah, and the reason why, John, as I tried to explain, is short-term gains are taxed at ordinary rates. So, you know, those are ones you definitely want to try to offset. So if you have these unrealized gains in a portfolio, there's an ability to what they call tax harvest that and realize those losses so that you don't have those short-term gains. So a lot of folks don't realize a lot of custodians or managers have the ability to do that. And then, you know, when I was talking about 1031 exchanges, you got to remember, you know, a lot of people think, well, I'm finding a way not to pay tax right on the gain. Remember, you're just deferring the gain, right? You're postponing it to a future date. But that can be a good thing. You know, as we sit today, we're certainly in a low interest rate or tax rate environment. People kind of recognize that taxes are probably going to have to go up. And if capital gain rates do go up, maybe you don't want to defer the gain. Maybe you take advantage of that now.
Right. So basically, instead of potentially just continuing to kick that can down the road, as I like to think of, maybe it's time to look at, hey, should I sell that property potentially to realize those gains now and basically start over fresh with ultimately like a new cost basis. So it's one of those areas that it's important to be looking at the tax ramifications of any investment. You don't want to, you know, be flippantly doing these types of transactions and not really paying attention to the ongoing tax implications that those can create.
Yeah, very important. This is why we do tax planning as well, because it's not only just about their investments, it's about how those investments are going to get taxed. So folks, if you're somebody that could use some of that kind of planning, certainly give us a call.
Professional golfers have a game plan. Knowing where to attack the golf course is vital, and avoiding the hazards is key. As you can see, we aren't professional golfers. But at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. And just like a good golfer, we have a game plan, a holistic approach for your financial future, using income planning, tax planning, estate planning, wealth management, and healthcare planning to help you plan to retire well. We have lived in Northern Michigan all our lives, and we have offices in Traverse City, Gaylord, Petoskey, and Cadillac. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
Hi, welcome back. Listen, in this segment, I want to talk to you about the reasons you might need a will. Okay? Now, this is just one of those documents they'll do when an attorney is doing an estate plan for you. Now, I am not an attorney myself, but I'm just going to give you some reasons that I've heard that they'll say that you need one for. First of all, a good estate plan is when all your assets know where to go. Okay? Now, a lot of times you can set that with a beneficiary designation. But if an asset doesn't know where to go, then it's going to have to go through probate. And a will becomes the instruction manual for probate in deciding where that asset's going to go. So if you had an asset that didn't have a beneficiary designation on it, and it's in the will that it goes to a certain person, and then it goes through probate, that's where it's going to go, exactly where you want it to go. That would be one reason to have a will. Now, you may think you're doing a good job setting all the designations or beneficiary designations in all your assets, but what if you add something later on and you miss it and you forget to put that on there, or somehow it gets lost? We've seen this happen with 401k plans. They were with one custodian, they set the beneficiary designation, that plan changed custodians, and then somehow the beneficiary information got lost, which is, happens quite often. Well, in that particular case, a will would catch that because it would go through probate and then know where to go. All right, another reason you might need a will is, what if you have a family, you still have kids at home, and you want to set who's going to be the caretaker for your kids, for your minor children? Well, you can put that in the will. Now, another good reason to have a will is designating who you want to be the representative of your estate. All right? You're going to want to set that. You're going to probably want to be the one that decides who's going to do that. Now, I've just given you some good reasons to have a will. Again, this is something when we're sitting down with the attorneys, we're doing estate planning, this is one they'll always want to put in there, but at least give you some ideas why you might want to have one. So hopefully you found this valuable. If you're somebody that wants some estate planning and wants to know how that fits in your scenario, then give us a call.
Thanks, Larry, for diving into that. And as far as estate planning and how all that goes, one of the key things that I like to point out to folks is simply beneficiary designations. I can't tell you how often it comes up in conversation of, hey, how did you structure that IRA, for example, to make sure it gets passed on to your spouse or children and everything. And sometimes I get that look back and people are like, well, I'm assuming I did it this way or that way, but then they actually dive into it and they see, oh yeah, I forgot to ever put my spouse's name on there. Oh, I never put my children, and the somewhat devastating results that could result in, potentially, especially if it's maybe like a second marriage and maybe you had your first husband or wife still listed on there. That takes precedence over whatever maybe a will or trust might say.
That's right. Yeah, very important that they get the right beneficiary designations. John, I was trying to explain to folks, if you have a good estate plan, it's when all your assets know where to go, right? The will only sees the light of day if anything has to go to probate. That means something didn't know where to go, right? So we'll get these people come in to our office, right, and you say, estate planning, I'm all good, I got a will. Well, there's a lot more that goes to an estate plan, as the estate planning attorneys will let us know, right? How about powers of financial? Sure. You know, when you become incapacitated, who's going to make those decisions for you, right? How about health care? You know, the day you're incapacitated and can't make your own health care decisions, who's going to make those decisions? And guess what? The person you have do the financial and the health care might be two different people.
Right, for sure. And that's where, I mean, I've been working through a case currently with some folks where dad wasn't doing so well and was here in Traverse City in one of the retirement communities and needed assistance. And so his daughter basically took over as that power of attorney, helping with all the financial decisions. And in this case, it was the son that was in charge of the healthcare decisions. And so that's where, again, like Larry pointed out, it may be different individuals that, you know, would be better suited to handle either the financial side or the health decisions on your behalf.
Yeah, I think it's good at the end of the day if the will never had to see the light of day, but honestly, they should still have one. You know, I tried to talk to that in the segment. You know, what if they forgot about an asset, right, and didn't have the right beneficiary designation, or somehow it got lost inadvertently? So at least they have a will that can catch that. So,
yeah. And that's where I've come across sometimes folks where they have, oh yeah, I bought that property. I've got that couple of acres and it's not worth a whole lot, but it was never designated appropriately. And so again, if that's you and you're not in a position where you're confident where your estate plan is structured, again, we encourage you just to give us a call and we can help connect you with the appropriate estate planning attorneys. Thanks again. We look forward to helping you plan to retire well.
welcome. In this segment, I want to talk to you about one reason that you might want to wait in taking Social Security. Now, there's a lot of factors that go into determining whether you should take it early or not, but I just want to give you one today that I want to focus on, and that's income taxes. Now, what I have here is I have a married couple. They're both age 62. They've decided to take Social Security early, okay? They're going to take a combined amount of almost $33,000 out. Now, they want $72,000 of income. So they're just going to take an additional $39,000 out of the IRA to make up the difference. Now, Uncle Sam says in this scenario, now it's kind of a complicated formula they go by to determining this, but basically they take half your Social Security, all your other income, and when you hit a couple different thresholds, it'll determine how much of your Social Security becomes taxable income. Now, I'm not going to go into great detail of that right now, but just understand that this couple taking almost $33,000 in Social Security, just about half of it is going to be taxable income. So then they get a standard deduction of $24,000. Their income tax in this particular case, or their taxable income, is $30,000, almost $31,000. Income tax, $3,330. Now, if they'd waited to age 70, okay, their Social Security benefits have grown, almost double what they would have been at age 62. In this particular case, if they waited to age 70, their combined Social Security would be almost $58,000. Now, they still want the same income of $72,000 at that time. So now, though, they only have to take $14,000 out of the IRA to make up the difference. Remember, back here they had $39,000. Now it's only $14,000. In this particular case, now Uncle Sam says out of that all that Social Security, only $5,528 of it is taxable income. Now, in this particular case, I got a little higher standard deduction because now they're older than age 65. But in this scenario, taxable income is zero. Income tax is zero. Now, how much tax do you want to be paying on your IRA money? I would dare say if I can get to a place where I can take money out of my IRA and not have to pay any tax at all, then that was a great scenario. Because remember, when I was putting money into those accounts, I was getting a tax deduction. Now, if I take out of those accounts and I'm not paying any tax, what could be better than that? Folks, again, there's a lot of different reasons why you might want to wait to take Social Security. This, again, was just one from an income tax standpoint, but very vitally important to understand.
If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen or visit our website at cen-wealth.com and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. Hi folks, listen, in this segment I want to talk to you about call options, most specifically buy call options, okay? So, you got to understand options can be very complicated. I've talked to you before about put options. When you buy a put option, you're thinking the market is going to go down. That's why you want to buy a put. But if you think the market's going to go up, here's where you want to buy a call, okay? So I'm going to kind of show you how this works. So let's just take ABC stock. It's selling for $100 a share, just to keep this simple, okay? And I want to buy a call on that stock. Well, I'm guessing that I'm going to buy this call and it's going to expire in 8 months. So I'm thinking that as of today, in 8 months, that stock is going to be up, okay? So based on the volatility of that stock and the expiration date and the time there, they're saying that if I'm going to bet on the upside, I'm going to say that in 8 months, it's going to be above $100, okay? So I'm going to pay a premium for that. It's going to cost me $10. That's my call. That's my money out on this bet. So where's my break even? My break even is going to be, right, the right to buy that stock, because I think it's going to go up, plus the $10 premium I pay. So anything above 110, I'm in the money. I'm making money. And guess what? My upside is unlimited, because if the stock went to $300, $400, $500 a share, I'm all in the profit above $110. Okay. Anything now, what if it goes below 110? Okay, I bet wrong. The stock in 8 months is below $110. Well, guess what? My maximum loss was only the $10 that I paid for the call. It basically just expires worthless. All right. Now, when you're buying a call, you got huge leverage when you're doing this. For example, let's say I'm just somebody buying the stock. I'm not buying a call. I'm just buying ABC stock for $100. I think it's going to go up. It does go up to $120 a share. What was my profit? $20 divided by my 100 that I paid, I'm up 20%. Not bad, right? But what if I'm somebody that bought the call? Remember, my only outlay was $10, okay? And now it goes up to 120. At the 110 I was at, I just gained $10. $10 investment, $10 profit. What did I just make? 100%. And not only that, think of it this way. I had to pay $100 if I was just a stock purchaser, but if I bought the calls, I could buy 10 times, right? I could, for $10 divided by 100, I can get 10 times the leverage. So how would you like to have 10 times the leverage making 100% versus the 20%, okay? Now, options, are very complicated instruments. You got to know what you're doing. But if you're somebody out there that might be interested in maybe getting involved in something like that, then certainly give us a call.
Again, Larry, really good information there. And when we're talking specifically about Social Security and the tax implications, one of the areas that I want to point out too is then the decision as far as your health care plan. So potentially if you're under the age of 65 and you're on the marketplace and potentially getting subsidies, there's an impact that your income will have that'll be dependent then on how much you get in subsidies. So that's a key piece as well when you're trying to determine how to structure your income surrounding your Social Security.
Yeah, and John, I just want to stress, and I tried to stress in that segment, that was just from a tax standpoint, sure, right? You're mentioning healthcare. Some cases they're wait Social Security to keep their income low so they can qualify for the marketplace insurance, right? There's all these factors that go into planning, and sometimes one works against the other. So all the more reason to have some holistic planning so you can take the tax considerations, the income planning considerations, your investments, estate planning considerations, and make sure they're all working in concert with your plan.
Yeah, so again, I mean, that's where here at Centennial Wealth Advisory, we like to look at all of those different areas. It's a holistic approach, so it's not just your investments. You're factoring in the income and the tax issues, and like we've talked about today, different estate planning issues. So again, we encourage you to give us a call. We love sharing this information with you, and we'd be happy to sit down with you one-on-one to talk more about your situation. Thanks again for tuning in to Retiring Well.